Welcome to Raos Academy, Hyderabad Branch. I'm Shwetashri. Today I'm here to teach some of the most important economics PYQs. Whereas the first question of the day is with regarding to the topic called important concepts of finances and again the important concepts of economics. So with regarding to that, the first question is, in the context of independent India's economy, which one of the following was the earliest event to take place? Here it is greatly asking and focusing on the chronology of different events in India. So here it is asking that which of the following event had took place at its earliest step. So here if you see the first statement, it is nationalization of insurance companies, whereas the first time the nationalization had took place in 1956 through that of the nationalization of LIC, that is the Life Insurance Corporation, and this LIC has been nationalized on 1956 in order to promote the different insurance services to different people and also especially in the rural areas. If you see the second statement, that is the nationalization of State Bank of India, whereas the State Bank of India has been nationalized in the year of 1955. If we get to see the background as well as the history of nationalization of State Bank of India, initially during the colonial period we used to have different presidential banks, for example Kolkata Bank, Bombay Bank as well as that of the Madras Presidency Bank, whereas on the year of 1921 all the three presidency banks were amalgamated in order to form a single bank which is called the Imperial Bank of India. Whereas after the independence, this Imperial Bank of India, which has been formed in 1921, has been nationalized and changed its name to State Bank of India on the year of 1955. Then followed by the enactment of Banking Regulation Act, whereas this Banking Regulation Act has been enacted in the year of 1949. Whereas if you see from the name itself, banking regulation, this act has been brought by the government of India in order to regulate the different banks under RBI, and RBI will going to regulate different banks in India based on the provisions of the Banking Regulation Act, whereas those provisions include the having a minimum capital, that, or you can say having the minimum capital requirement for the establishment of a bank, and also a particular bank need to take a license for its establishment, and also with regarding to that of expansion of those bank branches. So all of the different provisions with regarding to regulation of different banks has been kept under the Banking Regulation Act, and this particular act has been enacted on 1949, followed by introduction of first 5-year plan, whereas the first 5-year plan has been introduced in the year of 1951 to 56. And the main purpose of this first 5-year plan is in order to promote the agriculture as well as that of the irrigation services in order to promote the economic growth in India. So with regarding to these different options and again these different statements, whereas the earliest event that had took place with regarding to its years, if you see, it is the Banking Regulation Act, which has been established and enacted on 1949. So according to the given options, the option C is the earliest event. Then followed by consider the following statements. Here it has given again different events and the statements. It has been mentioned that RBI was nationalized on 26th January of 1950. If you get to see the history as well as the background of RBI, whereas RBI has been established under the RBI Act of 1934 and it came into force on 1935, whereas this RBI is a statutory body. What do you mean by a statutory body? For example, a body which is established particularly under an act, then we'll call that particular body as a statutory body. That means this particular RBI is also statutory body because this RBI has been established under the RBI Act of 1934 and it came into force in 1935. Whereas after the independence in 1948, there is a particular act has been brought by Government of India, that is called the RBI Transfer of Public Ownership Act 1948. So under this particular RBI Transfer of Public Ownership Act of 1948, this RBI has been nationalized. Initially, before the independence, during the time of colonial period, this RBI is a private entity, whereas after the independence, government has brought this particular law and made it into a nationalized bank. That means RBI. That means RBI has. That means the entire ownership of RBI has been brought under the Government of India under this particular act, and it has been came into force on 1949. So here the RBI was nationalized on 26th January of 1950. It is not on the 26th January of 1950, but on the 1st January of 1949, and the RBI has been nationalized under an act called the RBI Transfer of Public Ownership Act of 1948. So first one is an incorrect one. Then followed by the borrowing program of Government of India is handled by the Department of Expenditure of Ministry of Finance. So if you see here, so first and foremost, under the Ministry of Finance, there are different departments, and if you see a few of its departments, that is the Department of Economic Affairs, Department of Expenditure, Department of Revenue, and the other departments. So among all, it is the Department of Economic Affairs which is greatly responsible to handle as well as the manage different government debts as well as that of the government borrowings. So according to it, the borrowing program of Government of India is handled by the Department of Expenditure, but actually it is not the Department of Expenditure, it is actually Department of Economic Affairs. So with regarding to that, both of them are the incorrect ones. So the option is D, that is neither one nor two. And the next question is, a consumer is said to be in equilibrium if which of the following will takes place. First and foremost, if you see the question, it is talking about that equilibrium of a consumer. If you see this particular concept, it is brought under the theory of behavioral economics. So according to the theory of behavioral economics, a consumer is said to be in equilibrium when he is able to fulfill all his needs with the income that he earned. So with the income that he earned, he able to fulfill all his needs, then we will going to say that that particular consumer is in equilibrium. So here it is said, the first statement is he is able to fulfill his needs with a given level of income, which is directly a correct statement, followed by he is able to live in full comforts within a given level of income. So if you see among these statements, option A, which gives a correct statement with regarding to that of a consumer who is in equilibrium, and also why people will earn income and also why people will work in order to fulfill their needs. So here a consumer is said to be in equilibrium if and so he is able to fulfill all his needs by utilizing the income he achieved or he earned. So option A is the correct statement with regarding to that of third question. Followed by supply side economics lays greater emphasis on the point of view of which of the following. If you see here the term supply side of economics, so whereas the supply side of economics greatly talks from the side of producer or that of the manufacturer, and also on the basis of the supply side economics, whenever these producers and again the manufacturers invest greatly in the production, which lead to that of the increasing of the production of goods as well as that of the services, that's what will going to lead to economic growth or that of the increase of GDP. So in that way, the supply side of economics is very essential in order to promote the economic growth of India. And what does this actually, the supply side of economics greatly keeps emphasis on is the producer or that of the manufacturer. Among the given options, the first one, it is the producer, it is not the economy, it is not the consumer, and it is also not the middleman. So the correct answer for the fourth question is option A, producer. And the next question is, the national income is talking about what does the national income actually refer to? If you see the term national income, it has two important definitions. One definition is directly talks about the total value of final goods and services which were produced by the residents of India within a particular period of time. And the other definition for this national income is net national product at factor cost. So let's analyze and understand these two definitions of this national income. If you see, it talks about the total value of final goods and services which were produced by the residents of India within a particular period of time. What do you mean by this term residents of India? The residents of India refer to those people who will live in India for more than or equal to 182 days. So a particular person who lives in India for 182 days or more than 182 days, then we'll call him as a resident of India. If a person lives less than or equal to 182 days, then we'll call him as the non-resident of India. We'll refer them only as NRIs, right? That is the one definition of national income, then followed by that of the net national product at the rate of factor cost. And here from the name itself, net national product at factor cost. What do you mean by this term factor cost? Factor cost is greatly talks about the factors of production, and also on the basis of that we can say that net national product is referred to, it is the total income of all factors of production. That means in terms of land, labor, capital, as well as that of the enterprise. That means in terms of the rent from the land, as well as that of the wages from the labor, and again the capital, then followed by profits. So in such way, net national product at factor cost. So from here, factor cost refer to factors of production, whereas that of the net national product at factor cost refers to that of total income of all factors of production. And also there is a formula with regarding to that of this net national product at factor cost, whereas national income is actually referred to this net national product at factor cost, and the formula for this net national product at factor cost will be calculated on the basis of formula called net national product at market price minus net indirect taxes. And what do you mean by that of the net indirect taxes referred to? Here the term net indirect taxes refer to the subtracting the indirect taxes. That means by subtracting subsidies from the indirect taxes. So this is the formula of net national product at factor cost, which is talking about the national income, and its formula, or else you can calculate this net national product at factor cost that through this formula, which is called the net national product at market price minus the net indirect taxes, whereas this term net indirect taxes referred to through subtraction of the subsidies from that of the indirect taxes. So from this, let's solve this particular question. So here the net national, that means the national income, refer to which of the following statements? Here it is talking about the net national product at market price. No, it is not talking about the market price. Then followed by net national product at factor cost, which is directly a correct one. Then followed by net domestic product at market price, as well as the net domestic product at factor cost. So here the correct answer with regarding to the fifth question is net national product at factor cost. So that's what actually national income is referred to. And also let me again emphasize on the term national income. It has the two definitions, one being that of the net national product at factor cost, and the other definition of national income refer to, that is the total value of all final goods and again the services which were produced by the Indian residents within a period of time. So here the correct answer for fifth question is option B, that is the net national product at factor cost. And the next question is, match the list 1 with the list 2 and select the correct answer. On one side it has given up the purpose or that of the different sectors, whereas on the list 2 it has given a list of different commissions which have been set up. So you have to match the different commissions, and again and the relation of these commissions with which of these following list. Here the first one is with regarding to disinvestment of shares in disinvestment of shares in public sector enterprises. So it has been given by the Dr. C. Rangarajan in the year of 1990s, whereas Rangarajan has recommended that in order to disinvest the different shares of public sector enterprises, in order to promote the efficiency and also in order to reduce the fiscal burden of the government of India. Then followed by industrial sickness. Industrial sickness has been given by, that is the Omkar Goswami, whereas the Omkar Goswami is a commission which has been set up in order to tackle with the issue of industrial sickness, whereas he have given some of the suggestions in order to overcome the industrial sickness and again the different policy interventions. Then followed by the tax reforms. If you see here the tax reforms has been that means different tax reforms has been given by Raja Chellaya. Here Raja Chellaya in the year of 1993, this particular person has gave recommendations with regarding to the tax reforms and also with regarding to the tax reforms in order to make changes in the tax structure and also broaden the tax base and also reduce the taxes or to make a tax cuts in order to promote the investment and also which finally lead to economic growth. Then followed by reforms in the insurance sector. Insurance sector reforms has been suggested by R.N. Malhotra, and also the suggestions that he has made in insurance sectors include in order to privatize the insurance sectors, that means in order to extend the insurance services through private sector, and also in order to establish the IRDAI. What do you mean by this IRDAI? It is a Insurance Regulatory and Development Authority of India. That means just like how RBI is a regulatory body in regulating the different banks in India, this is a regulatory body which has been established in order to regulate the different insurance companies in India. So accordingly, after the match, it is the code of 4213. So here it is the option B is the correct answer, which talks about the 4213. So these all were the commissions and these all were the different recommendations or the reforms which has been suggested by these different commissions. Then followed by Hawala transactions related to the payments of which of the following. Before getting into different statements, let me give you a brief background with regarding to Hawala transactions. These Hawala transactions are nothing but they are the unofficial or the illegal transactions from one particular person to other particular person through overseas transactions through Hawaldars or that of the brokers. For example, if we take a hypothetical situation that in India there is an X person, whereas in USA there is a Y person. This particular person like to transfer a particular huge amount of money from India to US, but through an illegal means, not through that of the important official gateway payments, but through illegal ways or through that of unofficial ways. So he will going to contact a Havaldar or that of a broker, and this particular broker will going to contact with the Havaldar who is present in the USA. So there will be two brokers, and this X person will going to contact with the Havaldar in India. This particular person will going to transfer the money to the Havaldar in USA, and from this USA based Havaldar will going to transfer the amount which has been sent by this particular X person in India. So in such way the huge amounts of illegal amount will going to be transferred from one particular person to another particular person, and also from one country to another country through unofficial means, through that of these kind of havaldars or that of brokers, and this kind of transaction is called the hawala transaction. So with regarding to that, let's see the different statements. It is received in rupees against the overseas currencies and vice versa without going through the official channels, which is directly a correct statement. Then followed by received for sale or transfer of shares without going through the established stock exchanges. Whereas with regarding to that of fraud with regarding to stock exchanges, we'll call it as the inside trading or insider trade, or we can say it as the security fraud. Then followed by received as a commission for services rendered to overseas investors or buyers or sellers in assisting them to get over the red tape or in getting the preferential treatment. And this is greatly talking about the bribery or that of the corruption in order to overcome or in order to get away from that of different bureaucratic procedures. Then followed by made to political parties or to individuals for meeting the election expenses, whereas it is greatly talking about the illegal election funding. So among the given statements, so option A is the correct answer with regarding to the term of hawala transactions, whereas the remaining statements greatly talks about the insider trading, and again followed by bribery with regarding to corruption issues, followed by the illegal election funding. So this is all about this particular question. In India, the interest rate on savings account in all the nationalized commercial banks are fixed by which of the following? So first and foremost, if you see the actual structure of the banking system, there is a centralized or apex bank that is called the RBI, which will going to regulate the all different kinds of banks in India, which includes the commercial banks, cooperative banks, regional rural banks, as well as that of the all India financial institutions. So here it is talking about the commercial banks, and also it is talking about the nationalized commercial banks. So if you see from the name itself, the commercial banks, and the main aim of these commercial banks are in order to gain the profit. These commercial banks mainly act as a profit gaining businesses or that of the entities which will take the deposits from the customers and uses this deposit in order to give loan to other people at a higher interest rate, and from this interest rate they will going to pay a little to depositors and keep the other amount with them. So in such way these commercial banks will going to get profited. So here the question is with regarding to in India, the interest rates on savings account in all the nationalized commercial banks is fixed by which of the following given institutions? So this is all about the commercial banks. If we talk about with regarding to fixing that of the interest rates, usually in commercial banks there are two types of accounts in the demand deposits, one being that of the savings account for the individuals and the other one being the current account for the business individuals, whereas it is talking about the who will going to fix the interest rate return for this savings account. So here initially it is this particular provision or this particular interest rate will going to be fixed by RBI, but later on RBI is started using the MCLR method, that means the marginal cost lending rates. That means either a base rate or that of the marginal cost lending rate. That means the RBI will going to release this particular rate, and by adding or by subtracting a particular percentage to the given base rate, these commercial banks itself will going to fix the interest rates. That means the RBI will going to provide the base rate, and on this particular base rates the commercial banks will going to either add or the subtract a particular percent and provide that particular interest rate to that of the savings account holders. So according to the given options, it is the Ministry of Finance, it is not the Ministry of Finance, it is not the Finance Commission, and also not the Indian Bank Association. So the option is none of the above. Initially the answer for this question is RBI, but as of now the answer to that question is commercial banks, which itself will going to fix the interest rates which to be provided to the savings account holders, and this interest rate will be fixed based on that of the base rate which has been given by the RBI. So here the correct answer for this question is D, which is the none of the above. The next one is with reference to institution of banking ombudsman in India, which one of the following statements are incorrect? It is asking about the incorrect statement. So before getting into different statements, let me give you a brief background with regarding to banking ombudsman in India. So first and foremost, before getting into this concept, let me give you what does this actually the term ombudsman refer to. Here the term ombudsman is nothing but he is an officer who is responsible for the grievance redressal. That means this particular officer is responsible in resolving different issues, whereas here we are talking about the banking ombudsman. That means this particular officer who is responsible in grievance redressal of different banking issues and also different banking transactions. So if you see with regarding to in India with regarding to this banking ombudsman, there are different schemes have been brought by Government of India in order to promote the grievance redressal of different banking services, whereas in 2021 all those schemes were amalgamated to form a single ombudsman scheme, that is called the RBI integrated ombudsman scheme, whereas this particular officer, that means the grievance redressal officer, will going to be appointed by RBI governor itself, and this particular officer is responsible in resolving the different banking related disputes which were faced by different customers. For example, if the customer was not satisfied with the order which has been given by this banking officer or ombudsman, then that particular party can reach the appellate authority. For example, this ombudsman gave the order for the banking issue and that particular customer was not satisfied with the order which has been given by this ombudsman, then from the order given by this ombudsman, within 30 days that particular party has to make an appeal at the appellate authority, and the head of this appellate authority is the deputy governor of RBI. And this grievance redressal mechanism has been made in such a way it is completely free of cost. So in such way the Government of India has brought up with a single integrated ombudsman scheme, that is in 2021, that is called the RBI integrated ombudsman scheme, whereas this particular ombudsman, that means the grievance redressal mechanism officer, will be appointed by the RBI, and if the customer or a party who is not agreed with the ombudsman order or ombudsman verdict, then he can reach to the appellate authority within the 30 days and can appeal there in the appellate authority, whereas the head of this appellate authority is deputy governor of RBI. And also the grievance redressal services were completely free of cost, and not only the Indians, that means not only the residents of Indians, but the non-residents of Indians can also avail this ombudsman services or can avail this grievance redressal mechanism in India, and those NRIs can reach this ombudsman in order to resolve his dispute when that particular NRI should have his account in Indian banks. Then only such kind of NRIs can reach to ombudsman in order to resolve their issues. So here the question is, with reference to India institution of banking ombudsman in India, which one of the following statements are incorrect? It is talking about which one of them are the incorrect statements. So the banking ombudsman is appointed by the RBI, which is directly a correct statement, then followed by the banking ombudsman can consider complaints from the NRI accounts in India, which is also directly correct statement. As I told you before, here the non-resident Indians who have the account in Indian banks can also approach the ombudsman for grievance redressal. Then followed by the orders passed by the banking ombudsman are final and binding on the parties concerned. As I told you before, here if a party or the consumer or a customer who is not satisfied with the order which has been given by the ombudsman can reach to appellate authority within the 30 days. What do you mean by this particular procedure? That means the order which has been given by this ombudsman is non-binding, but it has given that final and binding, so it is an incorrect one. Then followed by the service provided by the banking ombudsman is free of any fee, which is also a correct statement, because this particular grievance redressal through this scheme is completely free of cost. So here the incorrect statement is option C, because the aggrieved party can reach to that of appellate authority if he is not satisfied with the order which has been given by ombudsman. So the correct answer with regarding to that is option C. Next one is, consider the following statements. Here the question is, the functions of the commercial banks in India include which of the following? So before getting into these different statements, let me give you a brief background with regarding to commercial banks. As I told you before, under the RBI there are different kinds of banks. One being that of the commercial banks, and the other one being that of the cooperative banks, and the other one being that of the regional rural banks, and finally all India financial institutions. So here the question is with regarding to that of the commercial banks it is talking about. Usually these commercial banks were profit based organizations or the profit based banks who will going to take the deposits, and based on these deposits, using them, it will going to give loans to people, and based on that of the interest they will get on loans will act as a profit to these commercial banks. So not only these commercial banks will act as the profit earning entities, they will also have the tie-ups with the different investment organizations, or they have their own investment wing in order to invest in the stock markets, for example in the national stock market or that of the in the Bombay Stock Exchange. And also these commercial banks will going to give advice to their depositors in order to invest in different stock exchange markets. That means they not only acts as the loan givers, or they not only acts as the lenders, they will also advise the different depositors in investing in the stock exchanges or that of stock markets. So here it is talking about that the functions of commercial banks in India include the purchase and sale of shares and securities on behalf of customers, which is a correct statement. As I told you before, they either have tie-up with different investment institutions, or they themselves have an investment wing in order to invest the money of their depositors directly in the stock exchanges. Then followed by they acting as the executors and again the trustees of will, which is also a correct statement. They will act as the trustees as well as the executors of the deposits, the executors as well as the trustees of the amount of these depositors in stock exchanges. So option 1 and 2, both of them are the correct answers. So option C is the correct one. So the next concept is talking about the external sector of India. Whereas the next concept is the external sector of India. So with regarding to that, the first question is the rapid financing instrument as well as the rapid credit facility are related to the provisions of lending by which of the following institutions? whereas these lending provisions will be provided by which of the following options it has been given. So let me give you a brief background with regarding to these instruments. Whereas under the IMF, that means the International Monetary Fund, there are two important instruments, one being that of the rapid financing instrument and the other one being that of the rapid credit facility. Whereas both of these instruments or both of these facilities will be given to the IMF members who were facing the BOP crisis, that means the balance of payment crisis. Whereas the RFI, that means the rapid financing instrument, will be used by the IMF in order to provide the financial assistance to different developing countries who were facing the balance of payment crisis. Whereas the rapid credit facility will be provided by the RBI in the form of providing the concessional financial assistance or that of the concessional loans to the least developing countries or that of the least income countries. So that is the greater difference between the RFI as well as that of the RCF. That means this rapid financing instrument will be used by the IMF in order to provide the financial assistance to different developing countries who are also the IMF members who are facing the balance of payment crisis, whereas this facility of rapid credit facility will be provided by the IMF to different IMF member countries who were facing the balance of payment crisis and especially who were the least developed countries through concessional financial assistance or that of the concessional loans. So accordingly, here the answer is the International Monetary Fund. So these two are the loan giving or these two are the financial assistance instruments of the IMF, that means the International Monetary Fund. Whereas the next question is, consider the following statements. So it has given the different statements that the tight monetary policy of US Federal Reserve could lead to capital flight. So first and foremost, you need to understand what do you mean by this tight monetary policy referred to and what do you mean by this particular term capital flight referred to. If you see this term tight monetary policy, usually in India also this kind of monetary policies will be used by the Indian Federal Bank, that means the RBI, in order to stabilize the price levels in India, that means in order to stabilize the inflation in India. So here the term tight monetary policy, whereas this term tight monetary policy will be used by the central banks in order to overcome the higher inflation rates. So in order to overcome the inflation, the central banks will going to follow the tight monetary policy. During the period of this tight monetary policy, the RBI or that of the central banks will going to increase the interest rates. With the increasing of the interest rates, the people will going to reduce the taking the loans from the banks. So in such way, these central banks will going to regulate the money supply in the economy. So in the same way, here the US Federal Reserve, just like that of the RBI in USA, what will happen if this tight monetary policy has been adopted by the US Federal Reserve. For example, if the tight monetary policy has been adopted by the US Central Bank, during this tight monetary policy, there will be definitely going to be an increased interest rates. So that is talking about the tight monetary policy. Let's keep it aside for a while. Then followed by that of the capital flight. What do you mean by the term capital flight refer to? Here the term capital flight refer to, there are different kinds of investments have been made by different foreign nationals as well as that of the foreign companies in India. We'll call it as the FDI as well as that of the FPI. That means the foreign direct investment as well as the foreign portfolio investments. So these FDIs as well as the FPIs will take away all the invested dollars which were present in which have been invested in India. So that taking away amount is called as that of the capital flight. Usually these FDIs or the FPIs, that means this foreign investment, will be made in those areas as well as in those countries which have the greater interest rates. For example, if we compare the interest rates of India with that of the USA, as per the given question, if USA is following the tight monetary policy, that means it is having the higher interest rates. For example, if the US is having the higher interest rates than that of the India. Whatever the FDIs or the FBIs which have been invested by the foreign nationals will going to take away their dollars from India and going to invest in the US in order to reap the greater interest rate benefits. So it will lead to capital flight. So that's what it was telling, that tighter monetary policy, that means due to increasing of the interest rates in USA will lead to that of the capital flight. That means taking away all the invested dollars from India in order to invest in the US stock markets. So that is what it is actually talking about. What will happen to these investments in India if the interest rates or that of the tight monetary policy has been adopted by the USA. That's what it is talking, that the tighter monetary policy of US Federal Reserve could lead to capital flight, which is directly a correct answer. Then followed by, the capital flight may increase the interest cost of firms with the existing external commercial borrowings. So here you have to understand that, for example, there is an ex-corporate firm present in India. Through a particular bond of $100, it took the loan from US member, but due to this capital flight, what will happen? There will be declining of the dollars and increasing of the rupees, right? So with the increasing of the rupees, it will lead to the depreciation of rupee. That means the value of the rupee will going to come down. That means usually $1 is equals to, for example, there is a 50 rupees. Due to that of the depreciation of the rupee, that means the decreasing of the value of the rupee, the $1 will going to be equal to the 100 rupees. So the declining of the dollars as well as that of the increasing of the rupees in the market will going to depreciation of the rupee. So that means the declining of the value of the rupee in the economy. So for example, at the whenever a corporate firm have took a loan, that means raised a loan from the USA on the basis of a bond of $100. At the time, it's, for example, at the time of taking the loan through this corporate bond, $1 may be equal to 50 rupees. But due to this tighter monetary policy of the USA, which lead to that of $1 is going to be equal to 100 rupees. That means because of the depreciation of the rupee, the value of the rupee will going to fall down. So during the repayment of these $100, it will going to be a very high cost or the huge cost for the corporate. So initially he needs to pay only 5,000 rupees, but now he needs to pay 10,000 rupees. Why this happened? Because of the depreciation of rupee, and this depreciation of rupee had been took place because of the capital flight, and this capital flight had been taken place due to that of the tighter monetary policy of US Federal Bank. So this is also a correct answer. Then followed by, the devaluation of domestic rupee decreases the currency risk associated with the external commercial borrowings, which is an incorrect one. It actually increases the currency risk associated with the external commercial borrowings. That's what I have told you, right? At the time of taking loan, its value is $100. That means he needs to pay the 5,000 rupees. But due to that of the devaluation of the currency, he needs to in return have to pay $100 only, but the value of that $100 has been increased to the 10,000. He took the 5,000 loan, but in return he has to return the principal amount of 10,000. So it increases the currency risk associated with the external commercial borrowings. So third one is an incorrect one. So 1 and 2 are the correct one with regarding to that of this particular concept. So let me give you a brief background again with regarding to this. That means due to tighter monetary policy, what will going to happen? It will going to increase the interest rates in USA. What will happen with the increasing of the interest rates due to tighter monetary policy? It will lead to that of the capital flight in India. That means all the investments made by FDI as well as that of the FBI will going to take away their dollars from India, and they will going to invest in the US market in order to reap the greater interest rate benefits from their shares. So tighter monetary policy in USA will lead to that of the capital flight in India. Because of the capital flight in India, that means this capital flight is due to declining of the dollars. That means whatever the dollars that have been invested through FDI and FPI have been taken away from India, which have been invested in the USA. So there will be a declining of the dollars. Because of the declining of the dollars, it will going to increasing of the rupees. So because of this situation, it will lead to that of the devaluation or the depreciation of rupee. Because of this depreciation of rupee, it leads to that of increasing of the currency crisis, especially for the external commercial borrowings. So this is the actual sequence for the given three statements. So here the correct answer with regarding to that is option A, 1 and 2. And the next one is, consider the following statements. So here the question is, the effect of the devaluation of a currency is that it necessarily related to which of the following. So before getting into these different statements, let me give you a brief background with regarding to how the devaluation of the currency will take place and how the evaluation or that of the appreciation of rupee will going to take place. For example, if we consider the rupee, whenever there is a declining of the dollars and again the greater rupees were present in the market, it will lead to depreciation of rupee. In the same way, when there is a huge dollars as well as the less rupee in the market, it will lead to the appreciation of rupee. And what were the consequences of this depreciation as well as the appreciation on the exports and imports? So for example, if you see, initially the cost of a dollar is 50 rupees. Because of the depreciation, that means the declining of the value of the Indian rupee, the dollar value have reached 100 rupees. So because of the depreciation, there will going to be a increasing of the exports and the decreasing of the imports, or the imports will going to be a very expensive. And how this situation has happened, for example, from in India, that a particular pen cost is 50 rupees. The cost of a pen is 50 rupees. So initially, before the depreciation, where the $1 is equals to 50 rupees, then the exports, that means then the foreign nationals can use $1 in order to buy one pen. Whereas in the same way, as of now, after the depreciation of the rupee, the cost will be remain same. By using the $1 by the foreign nationals, they can purchase 2 pens. That means the Indian articles will going to be cheaper for the foreign nationals because of the strengthening of the dollar and because of the depreciation of the rupee. So it will lead to increasing of the exports because of the cheaper products of India, and it will going to be imports will going to be very expensive, especially that of the crude oil. And the same process will going to be a reverse with regarding to appreciation. So appreciation is nothing but the strengthening of the rupee. For example, initially the $1 is equals to 50 rupees. Now the $1 is equals to 20 rupees. Because of this particular situation of appreciation of rupee, it will going to reduce the exports. That means exports will going to be expensive, whereas that of the increasing of the imports. That means we have a huge valued currency that we can buy anything very easily with the appreciated amount. So that this is what the consequences with regarding to appreciation as well as the depreciation of rupee. So here the question is, the effect of devaluation of currency is that necessary. So it is talking about the devaluation of the rupee. So it improves the competitiveness of domestic exports in the foreign markets, which is directly a correct one. From this I have told you, right, initially $1 is equals to 50 rupees. Then as the cost of a pen is 50 rupees, by using only $1, he can buy only one pen from India. Whereas in the same way, the foreign nationals, after the depreciation of the rupee, as $1 became the 100 rupees, by using the $1 itself, the foreign nationals can buy 2 pence. Initially they can buy only 1 pen, but now after the depreciation, by using a single dollar they can buy 2 pence from India. That means the Indian articles became cheaper and the exports became very easy. That's what it is talking, that which improves the competitiveness of domestic exports. So first one is the correct answer. Then followed by, it increases the foreign value of domestic currency, whereas the devaluation of the rupee reduces the foreign value of domestic currency. As I told you before, initially the cost of a $1 is 50 rupees, but because of the devaluation or the depreciation of the rupee, the value of the rupee will going to be decreased, so it have reached the 100 rupees. So it will going to reduce the foreign value of domestic currency. Here it is talking about the domestic currency, means for our domestic currency is rupee, right? So it is going to be, it's going to decrease, not increase. So second one is an incorrect one. It improves the trade balance. Usually as because of the depreciation or the devaluation, if you see with the increasing of the exports, so exports will going to promote the trade very well, but at the same time if you see the imports, because of the depreciation of the devaluation of the rupee, it had led to the imports became very expensive. So we cannot say necessarily here, as it mentioned that the effect of devaluation of a currency is that we can't say it necessarily improves the trade balance. So here the option A is the correct answer. That means the effect of devaluation of a currency is that it necessarily will going to improve the domestic exports competitiveness in foreign markets. So 1 is the correct answer.